Every year I post this same video about last minute superannuation contributions, and there's a reason for that. It's because this can be an awesome strategy to help build your wealth. For most people, it's a way to save tax because it gives you a tax deduction for investing money for yourself. Now think about that for a minute. What other investment out there gives you a tax deduction for investing money for yourself? Now, a lot of people turn to property when they want to save tax, and typically property only gives you a tax benefit if it's negatively geared and there's a lot of outgoing expenses. Whereas superannuation, you're going to get a tax benefit on the contribution that you make. It's pretty cool. Now, there are other reasons that you might make voluntary contributions to superannuation other than claiming a tax benefit, and they might include things like the government co-contribution, eligible spouse contribution, or maybe you're simply heading into retirement and you want to transition some of your asset base into the super environment. And we'll touch on these a little bit at the end of the video as well. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about last minute superannuation contributions, particularly focused around claiming a tax deduction. Now, before we jump into this, please remember that this information is only valid for the current financial year. So that is the 2021-22 financial year. So if you're watching this video after 1 July 2022, then some details may have changed and it may no longer be relevant. So let's kick this off with how superannuation can potentially save you some tax. If you are under the age of 67, you have the ability to make a tax deductible contribution to your superannuation. If you're over 67 but under 75, you may also have this same opportunity provided you meet a work test, which means you've worked at least 40 hours within 30 consecutive days in a financial year. Over 75, the door has closed. There are some changes coming to the work test next financial year, that's the 2022-23 financial year, but I won't confuse you with those details now. A tax deductible contribution saves you tax by allowing you to claim the amount contributed as a tax deduction in your tax return. Now, not only could this potentially save you tax, but it may also lead to you actually getting a tax refund. Now, let me give you an example as to how this can work. Let's say you earn $100,000 gross per year and you have no other investment income and no deductions. Throughout the year, you should have paid $23,767 in tax through the PAYG system. When you lodge your tax return, you don't have any additional income to declare nor deductions to claim. As a result, you will not owe anything to the tax office, nor will you receive a tax refund. The PAYG was spot on, so you are all squared. In the same situation, let's assume you make a $10,000 tax deductible contribution to your superannuation. In this instance, you still would have paid $23,767 in PAYG tax throughout the year, but now you have a $10,000 deduction to claim. As a result, the ATO will calculate that you've paid $23,767 in tax, but only owe them $20,017. So you will get a tax refund of $3,750. This can also be particularly handy if you're offsetting a realized capital gain. So if you've sold an investment throughout the financial year and you've made a gain on that and you know that you're gonna have to pay tax on that gain, well then a cheeky little superannuation contribution may help to alleviate some of the pain. Now, of course, everyone's situation is different and the amount of refund you get or whether or not you get a refund is gonna depend on your particular circumstances. But as this basic illustration shows, making a tax deductible contribution to your superannuation can be a beautiful thing. Not only do you have the potential to save some tax, but when the contribution is made into your superannuation, it's gonna get invested and then you're gonna benefit from having compounding investment returns over the years. But of course, like with everything, there are some restrictions around these contributions and some potential downsides that you need to consider. So let's kick things off by looking at the restrictions first. As we've already touched on, there are age restrictions which may limit your ability to make a contribution into your superannuation. But in addition to this, there are also contribution cap limits which you need to be aware of. A tax-deductible contribution to your superannuation will form part of your concessional contributions cap, which in the current financial year has a $27,500 cap limit. Just remember, employer contributions and salary sacrifice contributions form part of this cap limit. So before you make any personal contribution, you need to have a look at how much of your contribution cap limit you have left in the financial year, and also account for the contributions that are still yet to come in before 30th of June this year. You also have the ability to utilize any carry forward unused concessional contributions. So from 1 July 2018, if you haven't utilized your full concessional contributions cap limit, you can carry forward the unused amount for up to 5 years, provided your total super balance is below $500,000 on the 30th of June in the previous financial year. The easiest way to find out how much carry forward concessional contributions you have available is to log into your MyGov account, click on your ATO linked services, click on super, click on information, and finally click on carry forward concessional contributions. Assuming that you're eligible to make a contribution into your super and you have space left in your cap limit in order to do so, then there are still a few more considerations that you need to make before jumping in. Firstly, it's important to note that concessional contributions are taxed by your super fund at a rate of 15%. Given this, it's not going to be tax effective to make a concessional contribution if you earn less than roughly $20,000, as you basically pay no tax outside super. The net tax saving can be calculated as the difference between your marginal tax rate and the superannuation tax rate of 15%. If you're fortunate enough to earn over $250,000, then you're going to get slugged with Division 293 tax. This is an additional 15% tax on any contribution that would otherwise take your income over the $250,000 threshold. However, although you would essentially be taxed at a rate of 30% on your superannuation contribution, this is still a whole lot better than being taxed at your top marginal tax rate, which is 47% when Medicare levy is included. Once inside superannuation, you won't be able to access your funds until you meet your preservation age. Now, I won't go into detail here about how to access your super, as that is a huge topic on its own, but if you were born after 1 July 1964, then your preservation age is age 60. There are some limited circumstances in which you could potentially access your super early, such as a deposit for a first home, financial hardship, or compassionate grounds. And of course, before making a contribution into your super, you really should understand how your funds are going to be invested. And I always tell people to treat their superannuation like their own money, because it is your money. You need to be comfortable with how it's invested, you need to understand how it's invested, and you need to make sure that you're not just putting this money into a black box that you don't understand. Technically speaking, you have until the 30th of June to get your last minute super contributions in. However, you have to be aware that it's not going to count unless it is received by your fund and allocated into your account. So given this, we always recommend you try and get the last contributions in prior to the 15th of June, because this is going to give your fund enough time to receive the funds and have it allocated accordingly. Making the contribution itself is pretty easy. All you need to do is contact your superannuation fund and ask for the banking details as to where to send the money. So most super funds will let you do this via either BPay or EFT. Now, just remember, if you do it via EFT, there's normally a reference number that you need to list in the description to have it allocated into your account. Once the contribution is in, then it's time to fill in a notice of intention to claim form, which can be found on the ATO website. By completing this form, you are letting your super fund know that you intend to claim a tax deduction for the contribution, and therefore your super fund will allocate it as a concessional contribution. Upon processing the form, your super fund is going to send you out an acknowledgement of notice of intent. Now, if you use an accountant to help you with your tax return, then your accountant is going to want to see a copy of this acknowledgement in order to claim the tax deduction for the contribution you've made. And that's it. You've successfully made a contribution, had it allocated correctly, and are ready to claim your tax deduction. Now, if you do this, you're going to thank yourself twice. You're going to thank yourself once when you pay less tax, and then you're going to thank yourself again when you're older and you can access your superannuation and it's looking nice and healthy because you've made these extra contributions. As I touched on at the start of this video, there are other reasons that you might want to make a last minute contribution into your super other than claiming a tax deduction. And without going into too much detail, this may include the following. Access to the government co-contribution. So if you earn less than $41,112 and you make a $1,000 non-concessional contribution into your super, you may be eligible for the $500 government co-contribution. If you earn between $41,112 and $56,112, you may receive a reduced co-contribution payment. The eligible spouse contribution. So if your spouse earns less than $37,000 and you make an eligible spouse contribution of $3,000, you may be eligible for a $540 tax offset. And to transition assets into super. As you approach retirement, it may be a good idea to utilize your super to house as much of your asset base as you can. And why would you do this? Well, because subject to certain eligibility requirements, you can turn your super into an account-based pension, which is a tax-free entity. So that's no tax on any income, no tax on any capital gains, and no tax on any pension payments. Under these scenarios, you may be looking to make a non-concessional contribution as opposed to a concessional contribution. And non-concessional contributions have their own set of rules and cap limits which you need to be aware of. So I won't bore you with the details now, but just be aware that if you want to run with one of those previous strategies or the alternative strategies, then you need to do some research on non-concessional contributions first. But that's it for me today, guys. Thanks a lot for watching. If you got some value out of this video, then I would love it if you can give it a thumbs up, and I will see you guys in the next one.